Gold has been in a very funny situation, which is the following. Normally, you say, well, if there's inflation coming, why isn't the price of gold going to the moon? And why on earth would gold prices go up if there were deflation or disinflation? The answer is that you have to look at the yield to maturity on the 10-year Treasury note. You can buy gold, you can buy a 10-year Treasury note. So what's been true since last summer, August of 2020, is as the yield to maturity on the 10-year note goes up, gold prices that strengthens the dollar, and gold prices have gone down because the dollar price of gold is just another cross rate, just another cross exchange rate. If you knew inflation was coming, if you were sure of that and that's what was going to happen, you would know exactly what to do with your portfolio. If you thought outright deflation or even disinflation, just a declining rate of inflation heading towards zero was coming, you would know exactly what to do. But the point is, when it's up in the air, when it's up for debate, both sides are sort of having their day. And I say the everyday investor is sort of sitting there saying, what's it going to be? So I would say right now, the inflationistas, as I call them, have the upper hand. I don't mean substantively, but I mean in terms of the debate. There are far more articles, commentaries, keynotes, interviews about inflation, and they have some data on their side. I mean, it's not just made up. The April inflation numbers, and take your pick. We have CPI, PPI, PCE, core, non-core. I don't have to get into all those definitions, but we have 5 or 6 prominent measures of inflation, not to count all the more esoteric ones. But they were all hot. So the inflationists say, well, there it is. There's the data. It's going to get worse. Inflation is here to stay. Commodities are going to boom. Oil prices are going to soar. Bonds are going to crash. The great, bond market crash that they've been talking about for 40 years. Because the bull market started in 1981. I was there. It's still going strong. But is this the end of the bond bull market, et cetera? And then, of course, ramifications for gold. So if you thought that was true, you'd probably buy commodities, real estate. You would not want bonds. You'd be dumping bonds. You'd probably buy stocks. You'd be dumping gold, et cetera. There's a whole set of things you would be doing. At the same time, the deflationistas, and I'm in that camp, or disinflation as the case may be, that's more my view. I'm trying to be fair to the other side, but the view there is that, April and May were hot, no question about it. The data is right there. But the first thing you have to discount for are what are called base effects. When the U.S. reports inflation, everybody knows the headline number. It was 3.6% or 5. I'm pulling numbers out of a hat, but it was high. It was kind of in that 3 to 5% range. You would expect that, and a lot of that is not kind of new inflation or sustainable inflation. It's just the fact that you bounced off a really low number from the year before. I compare it. You fall in a 50-foot hole. You climb up 50 feet, but you're back where you started. So nice going with the climb. You did climb up 50 feet. That's a real number, but you're back where you started. So, and it's very difficult to estimate the impact of the base effects. Is what's the base? What would the inflation have been if we didn't have a crash? Well, no one really knows the answer to that. Some analysts go back to 2019. They say, well, let's not do year over year. Let's look at a 2-year frame, because 2 years ago the pandemic wasn't here, and you divide in half. You don't look at 2 years inflation, but use 2019 as your base. That seems like a legitimate method. Other people are using estimates, etc. But the bottom line is that the best estimates I've seen are the base effects account for about half of the reported inflation. So if you see a number like 4%, and that's about what it was really only 2% kind of new inflation and 2% base effects. The importance of the base effects is not that it's not real, it's that it's not sustainable. Because what's going to happen, we're going to get to August, September, October of this year. At that point, your year-over-year comparison is going to be August, September, October 2020. Well, guess what? The economy grew 34% at an annualized rate. In other words, not only is there not going to be a base effect in the negative sense, you're going to see some strong numbers from the year before, which is going to make the year-over-year comparison much more tame. Remember, inflation is a basket. Americans tend to judge everything by the price of gasoline. So they go to the pump, and gasoline used to be $2.50 a gallon. Now it's $4.50 a gallon. They go, see, there's your inflation. Well, gas prices are up. Again, you can have your opinions, but you can't make up your own data. Gasoline prices are up. Prices at the grocery store are up. But then people forget consumer electronics are down, tuition is down, healthcare is down, clothing is down. So it's a basket, and the number was hot. Strip out the base effects, and it's a little strong, but not nearly as much as it was before the base effects. But it's a basket of things. Some went up and some went down. So the things that were going up, independent of base effects, automobiles. Well, guess what? Automobiles are basically computers on wheels. The reason automobiles were going up was semiconductors. We couldn't get the semiconductors from from Taiwan. Taiwan's the main manufacturer. Well, you look around your kitchen, your refrigerator has semiconductors, your coffee maker has semiconductors, your automobile certainly has semiconductors. So a lot of the things that were going up, consumer durables, automobiles, etc., it wasn't because they couldn't get steel or Freon, whatever they need to make refrigerators, because they couldn't get semiconductors. Well, that's temporary. It's a big deal. So there are supply chain delays, but they're being worked out. So between the base effects, which are definitely temporary, and the supply chain effects, semiconductors in particular, which are likely temporary, and strong growth in the third quarter of 2020, which is going to be your base when we get into the third quarter of 2021, this inflation is just going to go away. You're going to buy bonds. You're going to buy the 10-year Treasury note. Residential real estate is probably going to go up. That's hot. But then, of course, what about gold? And gold has been in a very funny situation, which is the following. Normally, you say, well, if there's inflation coming, why isn't the price of gold going to the moon? And why on earth would gold prices go up if there were deflation or disinflation? The answer is that you have to look at the yield to maturity on the 10-year Treasury note. That's our benchmark security. A lot of people look at LIBOR, but I'm like, no. If you're making investment decisions, you're buying a house, you're doing capital investing, these are all 5, 10, sometimes 20-year decisions. The 10-year note is the right benchmark for those large, long-term investments. Well, that's an alternative place to put money. You can buy gold, you can buy a 10-year Treasury note. So what's been true since last summer, August of 2020, is as the yield to maturity on the 10-year note goes up, gold prices that strengthens the dollar, and gold prices have gone down because the dollar price of gold is just another cross rate, just another cross exchange rate. So a stronger dollar means a lower dollar price for gold. If you knew inflation was coming, if you were sure that that's what was going to happen, you would know exactly what to do with your portfolio. And it's very difficult to estimate the impact of the base effects, because what's the base? It was really only 2% kind of new inflation and 2% base effects. Why isn't the price of gold going to the moon? And why on earth would gold prices go up if there were deflation or disinflation? The answer is that you have to look at the yield to maturity on the 10-year Treasury note.